Welcome to the Growth, Grace, and Prosperity Podcast. Join Stewart Heath for down-to-earth conversations with top professionals, entrepreneurs, and leaders who have a story to tell. Let's get rolling.
Hello, everyone. I'm Stewart Heath, your host of the Growth, Grace, and Prosperity Podcast. Thanks for joining us for another episode. We are very lucky to have Steve Selengut, if I said that correctly, as our guest today. He is an author, and he's got a story, and we're going to get into learning all about him as much as we can convince him to share with us. So, Steve, thanks for joining us today.
Oh, my pleasure, Stuart. It's
Hey, Steve. Everybody has game-changing moments in their life, and I like to say, with people such as ourselves, of a certain age, we might have 2 or 3 game-changing moments.
true.
Can you share one or two with us, and that was maybe you were on a path, thought you were going to do something else, and then something happened, and that put you onto the path where you are today? So,
Yeah, I guess I did have 2, maybe 3, but the first game changer came around it sort of developed over the course of years from 1975, or rather from 1970 to 1979. In 75, when I was just turned in 1970, when I just turned 25, I was given, or it was handed to me, a portfolio of securities. I mean, not many people have that kind of a dilemma thrown at them. And it was literally 40, maybe 50 different stock certificates of different companies. Most of them, you'd remember their names, even some of those that don't exist anymore, like Sears Roebuck, for example. But it also included things like Shell Oil and I think it was still Esso.
did you have any W.R. Grace?
I may have. It's about that era. Yeah, it could have been in there. It was a New York Stock Exchange company. It was a B+ or better rated. I know I owned it over my career. But anyway, there were some unique things about this group of companies. Every one of them had been around for a long time, was successful, profitable, and paid a dividend. So I got focused on income immediately. They also traveled quite a bit up and down in their progression up to their highest levels that we see today. And my broker and I determined that, hey, if we just put these securities and any securities like them in what we call a universe of companies of this quality, all pay dividends and so on, and when some of them go up 10%, we sell them, and we find another similar quality company that's down, let's say 20% from its 52-week high, and we buy that one. Or we buy 2 different ones, or we add to some that we already have that are down, but we spread it around. We keep doing that over and over again. We would develop a very large stream of income. So that we started to do that. And while at that time, I was working in New York, and I was in the last phases of my career there, as it happens. I was working for a pension investment department. So I was learning a lot about securities and portfolio management and stuff like that. And I used their selections a lot in my own portfolios. But I was getting up at 6 o'clock in the morning or earlier, getting all dressed up in a 3-piece suit, driving 10 minutes away to get this bus to drive into Manhattan, and then walk from the Port Authority building up to 52nd Street in all kinds of weather, And in 1979, or a little before that, I was looking at what I was making there at this insurance company and what I was generating myself in my little gig with these wonderful companies. And I said, why am I doing this? Why am I doing it? Sandy, I'm making 5 times what I make in New York. Why am I going there every day? Why don't I just call Dominic and this guy and our dentist and say, hey, look at this portfolio. Look how much income I'm making. I can do this for you. And that was the changing moment of my life. That was it. And I did it.
Great.
And I got my licenses all together.
Did you start a firm to manage money for other folks? Yeah.
I formed a corporation. I took the tests. I became an RIA. I teamed up with a broker who was then, I believe it was at some small company. He had started out his career at Merrill Lynch and started. Then he went to several other brokers, and I put my money with him and mine and my 2 new clients with him, and we did this, and we started advertising and went to trade shows. I got on talk shows on that. There were talk shows on TV before the day of the podcast.
I remember.
And there were a couple of them. I got to be pretty much a regular on. One I had to pay to be a regular on. One I didn't. But anyway, the company grew and grew and grew, and it grew because mostly by word of mouth. After that initial phase, but it grew because we are income investors. Yeah. And just like in the real estate business, when you have 12 different apartment houses bringing you rents every month, it makes your life much easier when the price of homes that you're selling go up and down, or when interest rates change, and when they go real high, nobody wants to buy a house. You still have that rent coming in.
Yep. And
my dad was in that business, and he was doing the same thing pretty much like you are now. He was a developer, and he had insurance on the side of, and he was actually financing many of the homes he built. So that's what we developed. We developed this constant income stream regardless of what was going on in the markets. And we developed kind of strict guidelines as to how we would deal with profits. We never fell in love. We didn't just hold on to stocks because they kept going up in price. We played the market cycle. We sold them when they were up, and we bought others that were down. And then we just bought, and we were buying the same things over and over again and selling them over and over again. So it was really kind of a no-brainer, and you got comfortable. You didn't have to do a whole lot of research the next time you bought Exxon. Right. You just went and did it. So it became pretty easy. So that was the first turning point in my life. I got out of the city, started this business. We built a new home. All this stuff got done. I moved to South Carolina. We moved the business down, and the same guy I was dealing with then, he and I grew the business to 110 million. My part of the business was 110 million.
Wow.
He had another broker working alongside him, and he had around 100 million of his own, and my partner had about 100 million from regular brokerage business. So we had a good
sized business.
It was a good sized business even today. So I changed this. The SEC kept getting more and more into our lives. So we went with it was called Mid-Atlantic Capital out of Pittsburgh. And they took us in. They had many, many different independent brokers working for them. And they provided all the back office, all the interface with the SEC. And instead of an RIA, it became an IAR, investment advisor rep of them. So that, I guess, was almost like a stage 2.
Right.
To get the and we continued to grow, and then we got older somehow, and you start talking about, we never even thought about retiring when we were 65 or anything like that. We were having so much fun, and we were growing, right. and then the 70, I became 70, 74, 75, and I started, and I'd already trained his daughter to take over my business and stuff like that, basically. And lo and behold, we get bought out again. The LMK, our broker dealer, got absorbed into a bigger broker dealer that had many different broker dealers, and those people made us an offer we couldn't refuse. I got, and 110 million. I'm sure you know how much advisors get, and I was probably getting about 40% of the tickets. The offer was 6 years income in advance, and when you're 78, that's not bad. That's not bad. So I wrote a book, and I don't know, Retirement Money Secrets. This book right here, this pretty thing here. And I wrote a book, and I started a coaching business. So I coach people specifically into creating portfolios that produce income. And so I've had a few of those life-changing turning point moments, and I'm still going. I mean, I'm not looking to retire anytime soon.
You look great, and you look like you could still be pulling 16-hour days.
I try not to do that.
Yeah. It looks like you could if you needed to, but yeah, I wouldn't want to do that anymore either.
Yeah.
So, Steve, are any of these game-changing moments throughout your career, are any of them what you would call bumps in the road? Something negative that really, nobody expected? And if you got any of those, share with us how you navigated through them, if you don't mind.
I was very, very fortunate. I chose my parents well, if you want to say that. I didn't have any of those after college problems of debt issues. My dad never, throughout he always told me, he said he never had any debt, and I shouldn't ever have any debt. I had a lot of good training in the financial area from my family, and I just never got into a lot of trouble. I mean, I was a wreck in college in the fraternity house. I mean, nobody expected me to go anywhere, I'll tell you. I had a lot of fun, but back then, no. But I never. It was before the drug era. You didn't have so much temptation as young people have today to really get off the right path. So I didn't have any of that, and I had a wife that I didn't get out of line. She kept me on. She was probably more ambitious than I was for me, and she saw something in the process that we had developed that she said, this can really make it grow. She saw the money coming in, and she liked it, and she didn't let me get into any serious trouble or make any stupid mistakes of trying to do something new or different or add some special feature. If it's the old, if it ain't broke, don't fix it. She kept me focused and everything like that. And I really do think of her as the key element in my success and keeping me out of those moments where we went backwards. I can honestly say that we never had a step backwards. We had some, flatlining, and not in the bad sense, but where we were just going along in a row. But we never really took a dip or got in trouble. Yeah.
So your business is similar to mine in that we try to do something very similar to what you're doing through real estate, and I call mine boring deals. Did you ever get bored of it and want to go do investment banking or any of that kind of stuff? Or
I never did, and particularly the profit taking part of it. I always got such a kick out of that. How could there's no difference between Pfizer today was 47. I'm not talking about today, but Pfizer's here one day, And a week later, let's pretend 47, and a week later it's at 54. What's changed?
Yeah, nothing.
Nothing. People talking about it or whatever. So I'm taking that. I started thinking about it. I'm walking down the road and there's $100 bill there. I'm not going to walk by it. I'm going to pick it up. I'll look around. Hey, did you drop this? But there's nobody there to say, hey, look, did you drop this? I'm going to take it. And I felt the same way about equities, stocks. When they go up, it's a treat. It's just something, take it and move on. Do it again and again. So, the biggest moment where a change in the methodology took place began in the early 90s when I discovered, in most portfolios, well, you have some of what you deal with is kind of illiquid.
Yeah.
You can't push a button and sell a house. You
Right.
got a lot of work to go through. Well, it was the same way with things like corporate bonds, municipal bonds, some preferred stocks for very small issues, but investments of that nature, the income-focused investments, were very difficult to trade and even very difficult to buy and sell, even on a long-term basis, just to get rid of them or to get them. So when I discovered that I could buy a portfolio containing 375 municipal bonds from all over the country for $15 a share, and I could sell it and buy it and sell it without having to do anything other than, hey, Ken, sell that. That's pretty much it. That was a big turnaround moment for me. And I just wish I had discovered closed-end funds when I started back in 79. It would have been a real game changer. I mean, that 110 million probably might have had another zero on it, right? If
Wow.
we really, because the income, the distribution income is basically now more than the capital gains income. In 2021, we're just approaching that 105, 110 million in 2021. The distribution income from the closed-end funds, and we were pretty much all closed-end funds at that time, was like, $7 million. So that's roughly 7%, right? The capital gains income was the same number. And that had never happened before, but it's just phenomenal how different it became after we started, and it grew the business like Topsy because people heard about it. Retirees knocked on your door.
Yeah.
We didn't have to do any promotion at all.
I think the whole income investing side of the market is so underserved in the media. To me, everybody needs a foundation of income, and then once you get that settled, then you can go out and do some of the sexier things that you want to do. Go buy an IPO or something like that. But I just, as people seem to me, it seems as they teach investing, here's a stock, here's a bond, here's they don't teach you how to position yourself, and income.
Right.
Income's the foundation of it all.
Yeah, I mean, look at they're selling us all these companies.
Yeah.
And focusing on those companies and making them go up in price, and wow, isn't that beautiful? Look how rich you are.
Right.
But how did those companies get there? They get there with cash flow and profits. So why can't I, the client, why can't I get there by means of cash flow, profits? They design portfolios for the AUM, the amount under management, because that's how they get paid these days.
Yeah.
Back in the day when they were commission people, like when we first started, you could talk to a broker about buying income securities, and they were fine with that because they were going to get the commission and so on, and they knew it was good for the client to have the income. Today, they're all fee paid.
Yeah.
and they're paid on the market value, not on the income they generate. So it's it's not a good thing, and it's not the individual guys, the individual advisors are being trained that way, but it's the people up above who say AUM, AUM, AUM. That's what we want. That's what they bought from us. That's what they bought from us. They bought our amount under management, and they didn't pay us the last half of what the price was until there was a year that we proved that AUM was still going to be there, and that I wasn't going to go into competition with them or encourage people to leave, stuff like that. So, it's a sad thing. I mean, the real estate investment business with the passive rent type investing is a big thing. It's a great thing. And what I do is a similar thing. It's similar in the income that it generates, right. But it's tough. It's tough to find people who are willing to say, even people who own an investment services business say, and I send out on LinkedIn, somebody signs up and they'll send me a message. I'll send back, hey, read my book and let's talk about in your business, setting up a piece of your business that focuses on building income portfolios for people. I never get anybody returning my message. It's outrageous.
Yeah. I really think the investing public is rather poorly served. Steve, let's shift gears a little bit. How do you stay current? What do you do? What are the activities you do to stay up on the market or to stay informed on, how to coach people or how you might think about investing or managing a portfolio? How do you stay current?
I stay current by some time when you put in some of those hours that we were talking about earlier. Every month, I have about 250, 260 securities in my portfolios, because now I'm not a manager anymore. I'm a coach. But just like when I was a manager, I used to tell people, I'm never going to buy anything for you that I don't own myself. And that was a big, big selling point.
Yeah.
And today I say the same thing. I'm coaching and I'm going to show you what I'm invested in. And it's not a recommendation to you, but this is where you can focus your research and find what you want to do. But this is what I do. So everything that's in those universes, and I have 50 tax-free closed-end funds and about 100 equities and about 110 taxable income. And then for really big clients, I have a universe of 22 ETFs that pay significant income. And I can't get as much information as on them as on CFs, and they're a little flakier. They're not as stable. So I only recommend even looking at them to high net worth people, over $1.5 million in investment assets. But I look at those things every month. And every month I look at the price and the yield and how long it's been in business, which I know already, how many different securities are inside. Like I don't want anything that has less than 50 separate securities inside it. It's got to be diversified, and then I stretch out the distributions each month, and I keep a record of each one. When and I color code them as to which ones have paid special year-end distributions, which ones have gone up since December, which ones have gone down since December. And if I see a downward trend, I just cut them from the universe. And then I go out with a note telling people, I have a community of people who use these things, and I tell them why something's been taken from or why I've added something new. So I do a lot of groundwork to continue to vet the securities in there. So I can confidently, when I go out and I take a couple profits like I did today, I don't have to think twice about investing in something that I don't now own or adding to any of the ones that I have, and then the people who get the universes and had the universes at their disposal, they can develop the same thing, and they can change, and they can make additions and changes to their universe if they want to. I don't care, but that's how I keep up to date on them. If anything, let's say we had a situation like last when I did the February numbers, almost every price in both universes was up over January. So when I saw one that wasn't up, okay, stop. Let's look closer at this one. Let's go in there. Okay, what happened? Did they change a distribution? Is there any news? I'll look for news. I'll Google news. It's a lot easier to do research today than it used to be. Let me tell you. So I'll do all that. I'll do all that homework, and then I'll have it.
You do that once a month.
Do that once a month, and if anything comes up, now I've got this paid community now. And there are a lot of people are much more technically oriented than I, and they're just getting started. So they're doing a lot more research, and they read all this stuff that all these closed-end funds send out to them. So they'll see corporate actions taking place, and they'll tell me, like just the other day, there was these 2 Aberdeen healthcare equity closed-end funds that were going to give you the option of taking a stock dividend instead of cash. So I always take cash on everything. So they just alerted me to it. So I spread it to the whole group, and I told them that it'll go, if you have it set up for cash, it's going to go cash. You're going to have to tell them you want reinvest, and you really don't want to do that. You don't really need. I like to selectively invest all the money I get from these things. I don't like them automatically investing anything. So I always tell them that I'm not interested in it. So, and then they make their own decision.
My next question, I usually ask my guests, how do they, what do they do with their investable cash? But I feel like we've been talking about that the whole time. So you're still running your own personal portfolio the way that you basically started. That's interesting. How many different stocks would you say you've analyzed since 1970?
Oh, hundreds, literally hundreds. But I was very particular when I was doing just individual stocks. We used to call them investment grade value stocks. You could probably Google IGVSI or investment grade value stock index. And I had a guy that would maintain this thing based on, I tell him what stocks we were looking at. There were about 225 stocks. And I give him all the information. And he created an index for this investment grade value stocks quality check thing. And, so we knew pretty much, what it was going to be all the time. So that's 225 stocks I considered vetted that I could put into any of my client accounts and be comfortable with them. I didn't publicize it or sell it or anything like that at that time. I just used it internally for our purposes. But that was about it. And we didn't do any
using the term investment grade, and you would think anything in the public market is quote investment grade unquote, but what you're talking about is a small minority of the public stocks.
Oh yeah. But you know what it was from? S&P Corporation used to have a monthly stock guide. I don't know if you were in stocks before you were in real estate, but they had this thing called the monthly stock guide that they would send to brokerage firms and anybody actually who subscribed to it. And inside was every stock listed in every exchange with a quality rating. And B plus or better meant that it paid a dividend, basically. It was a high quality company. So my requirements was B plus or better, trading on the New York Stock Exchange, and paying a dividend. Those
so no NASDAQ.
Yeah, after the .com bubble, I went out with and I said, was it no IPOs, no NASDAQ, no mutual funds, no problem.
Right.
Because all I had was those investment grade value stocks, and they had really gone down during the dot-com rise. And where did all the money go when the bubble burst? Right back into that quality. So while everybody else was crying, I was taking profits like crazy.
Yeah, good for you. Yeah, the same thing is true in real estate. If it's a stabilized cash flowing piece of property, yeah, it's very stable and generally goes up in value. Of course, anything can happen, as anything can happen to any of those companies. But
Sure.
but most people, when they're novices to stock investing, they think it's, oh well, I just got to go buy the next tech thing so it'll go up. And and if you listen to the financial media, it's Nvidia, and 10 hours a day, and I'm sure they're a fine company, but I don't believe they pay a dividend.
No,
So,
they don't.
and
Microsoft,
that companies don't, So,
yeah, Microsoft barely pays 1%, if anything. Amazon, I don't think Amazon pays a dividend.
I don't think so. Apple doesn't pay one. I don't think so.
Right.
And these are the most valuable.
So,
companies.
So the other part of the closed-end fund thing is, just like when you look inside the income ones, you can find, you got 325 different muni bonds. When you look at the equities, you got 250 different companies in there. You've got Nvidia, you've got Amazon, you've got Berkshire Hathaway.
Yeah.
You got everything you want to have, but it's being managed for you in this portfolio. And right now, those portfolios are paying us 9%.
That's great.
Or better. So
that's great.
It's just that was a big turnaround in the 90s when we really got into them. And by the time of the coming out of the financial crisis, we pretty much totally converted from individual stocks to closed-end equity funds because of the yields and because it no longer was smart to buy the high quality companies that were down 20% from their 52-week high, because when everything else is up and there's only a few of them, you got to scratch your head and said, now, one more, this isn't a correction. This is a rally. We're not going to buy these things that are down now.
Right.
So we switched all the way over. So when I sold the business, there was not one common stock owned by any of my 150 clients. It was all closed-end funds.
Interesting. All right, coming down to the last question. If you were mentoring somebody, and this is important because you're a coach, if you were mentoring somebody or someone just wanted to follow in your footsteps, what one piece of advice would you want to give them?
I think since most people start thinking about a coach and stuff after they've already perhaps run into a few problems with their 401k or their IRA, or they've got an inheritance and they don't know what to do. I say that really the first thing to do is look at your existing portfolios and try to figure out how much income you're actually getting. And even if it's managed by somebody, just look at it. And you'll find that it's probably yielding less than 3% income. And in the long run, and it's a pretty good rule of thumb, you're going to need at least 4%. And you need 4% because they're going to tell you you're going to use 4% of your market value. So why can't you start immediately generating at least 4%? And so you're going to look at what you've got now and you say, I don't want to have a situation where I'm making 3%. I want a situation where I'm making more than what I'm going to need when I need it. I want to make more than 4%. I want to make enough to have that 4% plus any fees I'm paying to this joker. So maybe I need 6%. And I'm going to look around and see what securities there are that produce income. Or I'm going to call my broker and I'm going to say, I want securities that are paying 6% or more, and see what he has to offer me. Because there's so many of them out there. There
really is. Yeah.
I mean, you can go to REITs, BDCs. There are even some mutual funds and plenty of ETFs that pay more than 6%, which makes you really beg the question when you get these model portfolios and things like that they're pushing on us now. Why are they pushing portfolios that are yielding less than even 1% in some of those models?
Less than the rate of inflation.
Exactly.
Now, the way you're managing, it sounds like you're basically taking positions in closed-end funds. But what about how do capital gains fall in your definition of income? I mean, you were selling high and buying back low and stuff like that.
Yeah, I was, selling 10% and buying them back at a lower price, down 20% and so on. With closed-end funds, you're dealing with portfolios.
They're doing all that trading.
They're doing the trade. The manager's doing the trade, but the price of the closed-end fund, these things are trusts. They're pass-through trusts, which you're familiar with, I'm sure. All that money goes to the shareholders, 95% of it. So you're not going to see great rises in price. You're going to see a very narrow trading range. In the 250 I have, I don't think there's one that's over $50 a share.
Right.
90% of them are both below $25 a share. So it's a whole different ball game. Your profit margins are lower. If it goes up 5%, I tell people you gotta sell if it goes up that much. And the only time it's ever going to have a lot of them in your portfolio that much if you're in 2021 again. And then you might want to say, okay, I'm going to sell anything over 6% because almost everything is up 4% or whatever.
Right.
But there are times when really it makes sense to take almost any profit, because if you figure there's nothing in the profit range, then everything is down. So if I can take a 1% profit on a $10,000 position, I've got 10 grand that I can then go look at the bottom and add to things that I already own to reduce the cost and increase the yield, or buy another position that's down low and watch it come up. So the price at which one sells for me now is much different from when it used to be. My target is more flexible based on where we are in the market cycle. And I'm now dealing with two different market cycles, because we got the stock market and we got the interest rate sensitive market. Whereas interest rates go up, prices go down. Interest rates go down, prices go up. And yields.
I bet that's been real fun lately with the Fed lowering the rates, but the 10-year Treasury's going up and going a little crazy. But
well, I don't think there are a lot of people who expect any more downs in the rates right now. I think, and a lot of people are thinking of how high interest rates are now, but when you think about it, for decades before the Great Recession, 5% was low interest rates.
Yeah. Oh yeah. Yeah. I financed my first house sort of at the end of the the misery index period. But my first home mortgage, and I was tickled that it was 9.75.
Yeah. Right.
It wasn't double digits.
Right. Exactly. I know.
We had double digit home mortgage rates for years.
Right.
I'm in the real estate business. I don't. I like to say I don't care what interest rates are. Of course I do, but what I care about is the cap rate that I'm buying, and I want a positive difference between my interest rate and my cap rate.
Exactly.
But sellers, they want the opposite, and so it's always this struggle. But I just financed a property at 6.5 and doing it again tomorrow on a new close. I love 6.5. It's a great rate. You can do a lot of business at 6.5%.
Right. Right.
So it is interesting. So well, Steve, thank you so much for taking your time. I wish that we could do this for a couple more hours, over a coffee or something, because you clearly have It sounds like you've got it figured out, and you've been quite successful doing it. So
it's worked well for me. Yes, it has, and I'm trying to share that with as many people as I can. You know, you get to be almost 80, and all of a sudden, all these legacy issues start to, I got to get this out here. I got to get,
Right.
you know what I mean? It just changes your way of looking at things.
Where can people find your book? Is it at Amazon?
Amazon primarily. You can get it. You can order through the brick and mortar stores, and there are some other outlets for ebooks that you can get it. There's an Audible version available only at Amazon.
Oh, great. Yeah. Well, we will make sure those links are in the show notes. Would you mind sharing your email if anybody wanted to reach out to you?
Sure. It's in the book as well, but it's sanserve@aol.com.
Okay.
And I also, and my website, where there's also an email address, is at theincomecoach.net.
That's great. Thank you so much.
Okay.
Steve, thank you for joining us today. Thank you for taking the time out. Don't want to keep you from heading down to Florida. And to our audience, thank you again for watching another episode of the Growth, Grace, and Prosperity podcast. Come back and watch another episode soon. Thanks.
Thanks for tuning in to the Growth, Grace, and Prosperity podcast. If you'd like to be a guest, visit growthgraceprosperity.com/guest. We'd love to hear your story.